S&P's on pace for its best month since 2023, and this morning's inflation number in line with expectations. Former Federal Reserve Vice Chair Alan Blinder joins us this morning on the phone, also a Princeton University professor. Professor, good to have you with us. Good morning.
Good morning to you. Nice to be here.
Just as we were getting ready to have you on, Atlanta Fed came in with their tracker for Q2, 3.8. And we gave them plenty of airtime when they were looking for negative numbers in Q1. I wonder what you make of that and if we can avoid some more negative prints on GDP.
Well, I mean, maybe we can. The problem with the GDP numbers now and for a while, I fear, is the imports are so erratic because of on-again, off-again tariff policy, the vagaries of when ships arrive and when they don't arrive and whether they're full or empty. When they do, imports are a negative to GDP. So when imports surge, that pulls GDP down. When imports sag, that pushes GDP up, other things equal. So quarter-to-quarter GDP is going to be very difficult for a while.
Does core PCE this morning reinforce the idea that the Fed may be over-worrying about the impact of tariffs?
No, I don't think so. I think the Fed thinks, and most people think, that the price impact of tariffs, which is what you're talking about here, is not yet with us, or with us only in a trivial amount, and there's much more to come. Now, apropos of what I was saying a moment ago, how much more? When? Nobody knows. Donald Trump doesn't know. I don't think he knows. I'm not sure he even has an idea what he wants to do.
The only thing I would say, though, is that even if you think that goods prices are going up because of tariffs, if you look in today's print, Alan, core services prices were little changed. They were the tamest, in fact, in 5 years. We're overwhelmingly a services economy. Yes. Not to mention the fact that oil prices have come sharply down, and that also has an impact on inflation. So, yes, you can worry about the tariffs putting higher pressure on prices, but there are a lot of things going the other way, too.
Absolutely. I read this print this morning as confirmation of what wasn't so strongly confirmed before, that we're back on a very slow drip down of inflation, which we had been on before, and then it seemed to stall out. We seem to be back on that track now. And the question is,
so shouldn't the Fed be cutting then? I mean, that's what it was doing last year when we were on a downward inflationary track.
Yes. The question is how long that will last. I mean, goods prices are a minority of the price index, as you correctly point out, but they may shoot up, and that may raise the inflation rate. And that adds up to me, as it obviously does to Jay Powell and his colleagues, to wait and see. There's obviously no urgency. The economy is in pretty good shape, and they can very much afford to wait.
Finally, as we look at a chart of the long end today, 493, Kugler gave this speech yesterday, Alan, where she talked about the lower desirability of U.S. assets in a potential flight to safety event. Is that getting more discussion, do you think?
Oh, a lot more discussion. I mean, that would be up from zero a year ago. I mean, if you ask anybody a year ago, where do people go when they fly to look for a safety, it would be to U.S. and especially to Treasury bills. That's still largely true, but not as much as it used to be. And the concern is with the developments in the U.S. budget, both the political and the economic budget, or whether this traditional flight to safety role of the U.S. Treasuries, let's say, is not ended, but is impaired somewhat.
We're keeping an eye on that, obviously, watching CDS spreads on our sovereign debt and a bunch more with the jobs number a week away. Alan, hope you'll come back soon. Appreciate the time. Good to see you.
Thank you. Bye.
Alan Blinder.